Welcome, Kerwin, retiring to the stock market. Special part 1 of 2. How are you?
Doing well. How are you?
Very good. It's Father's Day, so we'll do a short session today. You're discussed a number that you're comfortable with. What was that number?
10,000.
Right. So, like, if you want 10,000 comfortably, and consider that's going to cover, extra things like insurance, which you might get from your job, like medical insurance.
Right.
What you really need is 20K a month, and the reason that is because you got your journal ready.
Yes.
Take notes. I'm putting the date here. It's the 16th today.
Yes.
June 16th, 2024. I got the stock market in the background. It's inching back up. And if you see my Netflix, going back to $700.
Yeah, it's working its way there.
All right, so let's write this down. Distribution of income. Distribution of income at the top of the page. Now, the first thing I'm going to put after distribution of income is 50%. 50% is what you can spend. If you're in any business, and this is why people, don't do too well financially or they get broke, it's because they'll make, 1,000, 2,000, 5,000, even 10,000, and they'll spend all that money. They have nothing else to do nothing with. So it's like no matter how much they make, they won't spend it all, and nothing to invest, nothing to take care of important things with. And let me show you what. So when you're going to make money, put 50% and put here live off spends. So when every 1,000 you make, you can only spend 500 in your business, whether it's stocks, real estate, other business. So, your 10K that you want to be able to spend has to be 20K income. So put there 20K a month. And that's 240K a year, which is about $250,000, just shy of $250,000 a year, which is a nice, you'll be doing all right. I might come over for a barbecue one day or something,
There you go.
Might check out your boat,
Sure.
All right. So 50% live off of, and we're gonna break down 100% of your income, your monthly income. So and then we have 10%. Under the 50%, you write 10%. 10% is actually, you know what? Let's make that 20%. After the 50, I want you to write 20.
Okay.
And 20% will be taxed.
Can't forget that.
I want you to file your taxes. I don't like to give tax advice, but if you're not filing, a lot of people do business and they don't file taxes, and it's not really correct because either they're gonna catch you one day or you're gonna have to owe, and it's a pain in the butt. So just put aside the money right away. Like when the thousands of dollars come in, like you did well on some trades, correct?
Right.
So just put aside 20% right away for taxes. That way, come next year, you have that money put aside. Okay. You don't have to sell stuff. You don't have to owe money. It's right there ready because you put it aside initially, and you're good.
Okay. So you just pull it out of your account, put it in a savings account, just let it sit till it's time to pay it in?
You can put technically you can put in something that's safe, that you think is safe, not trading, not options.
Right.
I mean, ideally, ideally you can still make some money off of, say, dividend stocks. you know, but
Okay.
even dividend stocks can go down drastically.
Right.
So the general rule is to just put it there like in a savings or checking that's collecting like a small amount of interest, you know.
Okay.
And here's something like this is something that you're gonna find out if you ever deal with other countries like Japan, for example, and other countries around the world. They don't even give you an interest, okay?
Right.
Like they do in America. America might get 1%, 3%, depending on what kind of.
Right.
Because what they figure is just to get your money back is a bonus, you know. So just to have stuff money into a safety deposit box, or some people put their money like in their pillow, you know.
Right.
So you need to have a place that's real safe, you know, for money.
Okay.
So
Gotcha.
put that 20% in say savings account. If it's a TD account, it needs to be, you know, safe investment, no trading, no options, you know. So you have that
Right.
money there. Okay.
Okay.
So put tax. Okay. Now about tax, you're going to need to do some accounting, right? So you need to know how much, like after every month, do a little accounting. Okay, so we have, you know, we hit our goal of 20K. You know,
Right.
we're gonna put 4K right here, slide over for taxes. You know,
Okay.
and at the end of the year, when you do your taxes, okay, so you hit your goal, 240K.
Right.
Congratulations. So you have 20% there sitting there for taxes, and it's good. Like you already know. You're not like
Right.
people like end of the year doing the taxes, you know, pulling their hair out, you know.
Right.
You already know. It's already there. It's like you don't have to worry.
Okay.
All right. 10%. So you got 50, 20, and then here's another 10%. 10% is to reinvest. So we're already spending 50% to live off of because you retired in the stock market. Congratulations. But we're going to put another 10% to reinvest, meaning we're going to put 10% back into our account so our account is growing, right? Account or accounts, if you have more than one,
Right.
are growing. So you don't want to just have the same amount of money there. You want it to be growing, okay? And so we're going to put 10% back. So you always want to be like growing exponentially. That's just healthy, you know.
Right.
Ideally, you don't want to dip into your original balance, for example. You know what I mean?
Right.
All right. So it's 50, 20, 10. That's 50, 70, 80, and then 20 more percent. Where do we put this money? The last 20 is going to be tied in. That's your time, okay?
Okay.
All right. On the last 20, you're gonna put oh, you know what? Okay, this one is savings. So the next 10 is going to be savings, which is, and then put little parentheses, take out. What I've always done from the beginning is when I do a real successful trade, I'll do a withdrawal, like to benefit myself, to treat myself like, oh look, I made $1,000. I'm gonna write a check for 100. By the way, do you have checking in your account? Free checking they offer at a TD 12, or do you have to do like a transfer?
Yeah, I'll do a transfer.
So like I recommend to call your broker and tell them you want the free checking.
Okay.
Because it makes it much easier to pay bills. Like you can literally, like, they're gonna send you a book of checks. It goes to your account, and you're going to like, look, water and power bill, write the check, call the phone, and you know how you pay checks over the phone.
Yes.
Basically, you don't need the physical check, but you're going to get the physical check. You don't need to mail that anywhere. You just need to call and like you can pay your mortgage, your rent, your utility bills, with just checks over the phone with your free checking account. Follow me?
I got you.
That way you're not just transferring which actually transferring sometimes takes a couple of days.
Yes.
With a check actually it floats for a couple of days. So what I do, I'll pay my bills. Let's say I pay a credit card, I'll write a check, right? And just make sure the money's available in your TT Schwab, right? And the check won't even hit for like 2-3 days.
Right.
So it's floating, right? And meanwhile, I got a credit card paid. I go out and I can use the credit card, or I got a utility bill paid. It's done. It's paid right away, immediately. Get the money immediately when I pay, but then that amount doesn't even hit the account for several days after. You follow me?
Right.
So that's the advantage of having a free checking account, is that you're going to it's easy to pay all those bills. It's accurate. You have it accurate. You have a ledger. You have this amount. You have check numbers. I think it's much better to do in transfers because it gives you more flexibility. Okay.
Right.
I have a note here. Order free checking. Now, like if you're in the margin account, which you do have a margin account, correct?
Yes.
Another value in the free checking is like a checking account is you can write a check, and because you have margin account, the check will automatically clear as long as you have those funds are marginable. So let's say you have 100K, right?
Right.
Your account. Let's say your stocks are 90K because you have 10% cash because you're being accurate on your account.
Right.
10% cash, 90K in stocks. You can write a check for 20K, which will technically put you over to 110K, but it'll clear because it'll just go into your margin.
Okay, I get you.
Follow me?
Yes, sir.
So you won't bounce checks as long as you have that flexibility of margin. It's just like you can with 100K, you can buy up to 200K in stock. You follow me?
Right.
I don't want you to do that. I want you to maybe spend anywhere between 90 and let's say 120. 10% margin, 20% margin. Just use it like when you have your absolute best trade. You're going to succeed.
Right.
At those rare times that you have that great trade, you can dip into your margin. Not forever, not for a long time. And that way you're using your margin accurately, and you can write checks and they'll clear, and you have that flexibility.
Okay, I got you.
Okay, so when you take 10% out, the value is that you're gonna write this down. Have something to show for it. Okay, so when let's say every $1,000 you make, think about taking out $100 to put into your kid's savings account, or put into a separate savings account, not stocks, not even related stocks. Okay.
Right.
Because sometimes what will happen is as traders we'll build up our accounts and then we'll have a big loss.
Right.
Okay. And then we have nothing to show for it.
Right.
Let me tell you a story. I knew a commodities trader trade soybeans. Okay. Soybeans and lumber, right? So he was doing well. He built his account of $10 million. Okay. And he was already quit his job, doing well. Like a couple years later, I talked to him and he had blown his whole account. He had lost everything.
Really?
Yeah.
Wow.
So and I was talking to him, and what he told me is that he wished he paid off his mortgage when he could. He could have paid off his mortgage, but he didn't.
Right.
That he had to start all over again from scratch, So the point is that he did very well, but he had nothing to show for it at one point. So don't let that happen to you. If you can build up your account and get these successful trades, you're taking out 10% every time, because that way you can have something to show for it. You're not gonna be that soybean trader who went to $1 million, then went broke and had nothing to show for it, like nothing.
Right. Okay.
So he should at least pay, like, if you do get to the point, pay your mortgage, pay that car loan off, because a stock market trader is a risky position. There's no, because you're working with, you're trading money. What you're doing, you're trading money. It's not just like if you go to a job, you put your hours in, you're expecting to get a paycheck.
Right.
When you're a trader, you put hours in, the paycheck's gonna vary.
Right.
Okay. What I've done, which makes me happy, I bought like silver coins. Like silver coins you can give like to the kids.
Right.
Put some money that your kids a savings account. Those things like this, just stuff that you're gonna have that later, no matter what happens. Follow me? So we got 50 live off of 20% tax, 10% reinvest, 10% savings, and the last 10% is to tithe. By the way, any questions so far?
Oh, sure.
So the last 10% is to tithe, and tithing is to give back to the community. And the value of tithing is like a philosophy. Like if you're helping people less fortunate, or if you're putting money to a cause that's you think is important, you're giving back. Like you're write this down. You're obligating the universe, obligating the universe. Also, you can say good karma. You know what karma is about? You believe in karma?
Yes, sir.
In the religion, you can give money to the church. You can give money to homeless dude. Help out somebody that needs help. I'm not talking about pay somebody's iPhone bill. I'm not talking about that. I'm talking about something that you can generally help someone that's less fortunate.
Right.
What I've done is something different. Like I go to a gas station, like on a corner block when it's like real busy.
Right.
And I'll just stand at the register, and I'll notice people come in. They just want to get gas and go about their day. But what'll happen sometimes is you'll have someone comes in, just wait there. Someone will come in and I'll throw money on the counter, like empty out the change purse, $7.53, and $7.53 on the counter, trying to count their dollars, because they can't even fill up their gas tank.
Right.
They can barely get home, I'm sure you were there one day, I've been there one day, like, damn, where's my money? Like, and I'll just like step up, like I drop 40 down there, just fill the rest up, get the change,
Right. There you go.
And you'll be surprised, like the reaction you get. Like you'll be surprised, like, why are you gonna do that for me? Like, man, you're like my angel, dude. Like, give me your phone number, I'll get you back. Like, don't worry, dude. Just go, like, take care of business.
Right.
So any little thing is gonna give you good karma. I think obligate the universe and give you a chance to give back to the community, whether it's a church or individual or something that's gonna let you help the less fortunate. That's 100%. 50 live off 20 tax, 10 reinvest, 10 savings, and 10 tithe. Any question?
No, sir. I like those numbers. So, question. So to say the 10, it's actually more than I need. You know what I mean? So what do you recommend doing with that extra from that? You know what I mean? Just the 50%, which is 10. You know what I mean? So you done just what, sit that in savings and just let it sit there? Whatever's extra?
What's more than you need? How much?
The 10,000.
Well, the theory is that you don't want to have less, you know what I mean?
Right. Right.
So I think listen, you, that money's gonna go somewhere, trust me, you're gonna have extra because like my experience, like when you're on your own, you're gonna easily buy something else, buy your wife some a present, buy your kids want to get some shoes, there's always gonna be extra expenses,
Oh yeah, of course.
So if sometimes when someone says, I want to have 6K, I want to have 10K, just round it up, 8K, 12K, because what happens is that money's gonna go somewhere, car's gonna break down,
Right.
So I don't think that's gonna be a problem for you.
Okay.
If you really have extra money, you can just reinvest it if you want. Doesn't matter. I don't like cheapskates. Like I think if you're like stingy, what's the word, stingy? I think that kind of like it blocks the beneficial energy. I think you should be generous. Like, so if there's a birthday, hey, it's your birthday. Hey, I got you. Father's Day, Mother's Day, anniversary. I believe be generous because it creates a good energy.
Right.
Okay. Any questions on that?
No, sir.
Okay, so you got distribution of income. We got 20K a month. And I want to talk about next what kind of trade you can do to get 20K a month, right? Because we're doing accounting, we're doing math, and we're going to put it down on paper to work. You want to talk about your trade, or you want to keep that private?
Oh, we can. It doesn't matter.
So, what was your successful trade this last week?
It was actually two separate trades. One on the ES, one on the SPX. I did 2 butterflies, one pre-market for that news, and when the Fed got ready to speak, I did another butterfly. Each trade, I was in them probably a total of about 4 minutes in and out. So, but
what was the SPX?
It was butterfly.
Give me, what's the price on that?
The total cost of it?
Yeah, but you traded a strike, right?
Yes.
So what strikes on the SPX?
I'd have to go look for you. I can go look though if you want.
Can you just give me an example?
Okay, I would do say the center strike was like 53.80, and then I would do say 53.60 on one side and say 53.40 on the other side, or just kind of something like that. We'll do what I would call a 20 wide.
These are net credits or net debits, meaning your debits.
Yes.
And butterflies, you said.
Correct.
Now, what about the ES? You say ES?
Yes, that was also a butterfly. Yeah, I don't know the strikes right off top. I should have got my other book, but it was just kind of the same principle. Do 20 wide. Say do right at 5,400. Do 54.20 on one side and like 53.80 on the other, or something like that.
So, these indices are going up,
right?
And you're trading them in an upward trend and closing.
Oh yeah.
Well, or they going down.
Well, the ES trade was a call butterfly, and the SPX trade was a put butterfly.
So the SPX went down, and you closed at a profit, and ES went up.
Correct.
And you closed at a profit. Okay, so you can see the trends. You can see the trends of the market. and you can see that you can take advantage. Like, for example, the ES going up, you enter into trade here, and you close the trade after it goes up, right?
Right. Well, what I
And
do is go ahead and
go ahead.
what I do is go ahead and set my closing order. I put the trade in, and then I go ahead and set my closing order. So, because I don't know how much you know about butterflies, but they benefit greatly off of the volatility. So I enter the trades when the volatility is at its possible lowest that I can get in there, and I wait for that expansion of volatility, which also increases the value of the butterfly. So I'll enter the trade, and I'll go ahead and put my closing order in. So each trade I try to enter it right before the volatility that I'm expecting. So it hits. And on the ES also, I should say that I put a butterfly on both sides of the trade. So I put one on top, one on bottom, so it really didn't matter which way it went.
But being that it did move, you got that benefit.
Correct.
So this an example of this. By the way, that's a nice trade there. Another example I can use for our video is just the Qs. Okay, I like to trade the Qs, and knowing that we're going up, we're going to break into new highs. But right now the Dow's not a new high, but the Q and the S&P 500 broke new highs.
Right.
So we're trading the uptrend. Okay.
Right.
So we're getting here. So the Qs are like 476, right? But they were about 450 not too long ago.
Right.
So if you like buy 476, if you bought like, so today's we're in June, right? So you go out like 2 months to August, right? August or September, and you can buy like the 500, which is out of the money, okay? But it'll cost you like $1 or $2. Okay, here's the value I want to show you, and we know we're breaking new highs. We're going in the uptrend. It's going to continue higher. That's the theory.
Right.
If you're right, you enter here. Let's say 476. Now let's say fast forward 1 to 2 weeks, it might be 486, 496. Okay. Now because we're following this trend, we're going higher. We're breaking new highs. We're long. Let's say calls. Let's say we buy 500 calls for 1 to 2, 3 months out. Now the $1-2 calls became $5-6.
Right.
So like basically like times 5 or times 4 times 5. So you let's say you put $1,000, you just got $5,000 just by riding the uptrend. So that's like example a trade that I do. If you look at Chipotle is about to do a 51 stock split.
Right.
CMG. It's at an all-time high. It's going up. Same thing with NVIDIA. NVIDIA, they just did a 10th stock split. Broke all-time highs. It's going up.
Still going up. Right.
The triple Qs. Now, triple Qs is an indice that for the recording is the top 100 Nasdaq stocks, mostly tech. That broke new highs going up. So SP 500, you can trade the SPY.
Right.
That's going up. So and look, Netflix, my Netflix is about to, I think it's about going to break 700 and go into a new high on Netflix too. So I call this following the trend. You know, never bet against the market, always trade with the market.
Right.
It's very, very tricky going against the market because now if you go against the market, you're saying you're like going to guess or forecast when the trend's going to break and correct. You know, like a lot of people will say that as a trader, whether you're long or short, you're right because it's going to eventually turn around, or it's eventually going to go back up. So what you need to think about is the timing. Write it down. As a trader, timing is most important. And that's because you can actually follow a trend. Hey, look, we're on the Qs. We're doing great. But if you don't take your trade, you don't close that trade, you don't pull the trigger, eventually that whatever position you're in is going to turn around and do what?
It's gonna go the opposite way and evaporate
Right.
on you.
Right. So it's all about timing. Like you
Right.
can actually buy a put and a call, and they're both going to actually come in at some point,
Right.
according to timing. So it's not so much that you have to be so smart that you have to know exactly where the market's going, but you just have to have the right timing. Like you did your volatility, you did your timing. How short was your trade? Like an hour?
Oh no, not even about 6 minutes each. Really, jump in right before the expected news. Jump in and wait for that expansion of volatility. Wait for the price to move, and I've figured out that just about every time I do that trade, my target. I don't try to set my target at crazy amount. You know what I mean? Like for the SPX trade, for instance, though each contract was 50 cents, so $50 per contract. So I set my profit at my profit target at $5. Soon as price moved, not even I jumped in. 3 minutes later, the Fed chair got started talking, and the price all it did, and it didn't stay down. It just dipped. When it dipped, hit my profit target. I think he started talking at 1 o'clock my time, 1:03. I was out of the trade. The profit target was hit. I got in it
Wonderful.
by 12:57 or so.
Wonderful. And there's going to be some more volatility come this November. You know about that.
Yes.
That's going to be a big volatility time too.
Yes, sir. Looking forward to it.
So we're just identifying trends, and most importantly, we're using the right timing. We're pulling the trigger at the right time.
Right.
And you said something key. You don't have crazy goals, because look, take small gains and walk away. Write that down. Take small gains and walk away. The problem with holding out for a big gain is that you're also, if you have that mentality of waiting for a big massive return, which people do get greedy and they wait for that massive return, you're also going to set yourself up for a massive loss. Okay.
Right.
And if you're doing small gains, like 6-minute trade, I might do a trade that's let's say 2 or 3 weeks. Even though I'm buying options that go out for 2 or 3 months, I want to close my queues in like maybe 3 weeks and then do another one.
Right.
Take my 10% out, go to dinner, pay a couple bills, and then redo another trade, which is maybe a higher. Like if I traded at 475, my next trade might be at 500, 510.
Right.
I don't have to have this one trade and just waiting for the thing, because eventually that thing will correct and then we're going to go back down.
Yeah. I
So
mean,
it's
like
time.
that SPX trade, for instance, if I had tried to hold it, it would have closed at zero, because the butterfly closed at no value. You know what I mean? So that's the reason I learned that also, that I'm not trying to hold this thing. I want to get in and get out of it. When I do those trades, I want to be in and get out, because you don't know which way the market is going to go. When they decide to go there, and if you're still in there, you're going to have a hard time getting out of it. And hence the reason why I figured out I just go ahead and set my closing order right now. So as soon as the volatility spike, it hits my target and I'm out. So I got
That's
you.
right. And that's why I have so much volume. Like, let's say, for example, in a stock, you can have like Nvidia, you can have like 100 million volume,
Right.
because there's traders that are just trading like constantly throughout the day,
Right.
buy, sell, and they're looking for that trend, if it's a volatility index, they're looking for that volatility, and they're trading constantly looking. And oh, by the way, as trading success versus wins versus losses, right? 7-3, 7 wins versus 3 losses out of 10 trades. You need to have 7 wins over 3 losses or better. That's a good, decent goal to go for. If you have 6 wins and 4 losses, you're going to end up breaking even. You're not going to, because of the law of diminishing returns, you're not going to make it. Ideally you have 8 and 2, Ideally 8 wins and 2 losses, but if you in the market, if you break even, if you do 5 wins, 5 losses, that's actually a loss.
Right.
Do you know why that is? If you do 5 and 5 and equal money, equal position, do you want you to have a loss?
What's that? No fees?
No, not even fees. It's because there's a law of diminishing returns that says, like, if you have 100, let's say you have 100K, okay, and you make a trade, you make 10K, 10%, okay, how much you got now?
How much you start with? 100?
Yeah,
What, 120, 110?
110.
Right.
Congratulations, you got 10K. Good. But now you got a 10% loss at 110K. Now, where are you at?
That about 12.5 or so.
Get your calculator. You have a calculator?
Yeah. I'm well on the phone.
Do 110 times 10%. I'm gonna show you about accounting. Gotta be accurate. Accurate meaning you want to select the best.
So that's 11,000.
And take 11,000 away from 110K. Where you at?
You're 99.
99K. Look what happened. Now let's do it again. Plus 99K plus 10K. Where we at?
109.
I'm sorry. Plus 10%. Where we at?
9,000.
Not exactly 9,000. 99,000 plus 10% is what?
It's 108,900.
108,900. Now minus 10%. Do 10% on that. Minus 10%. Where are we at?
$98,010.
Look what happened. We got 10%, lost 10%. 10%, lost 10%. We dwindled down. Down.
Right.
So when you lose money, you actually lose more because you're losing your ability to make money. Okay.
Right.
So you cannot trade blows with the market. You cannot do break-even trades. You're gonna be at a loss, net loss. Right. So you got to have a winning strategy. I say mathematically, every 10 trades, you got to have 7 wins and 3 losses. That's just my philosophy. Ideally, you're 8 and 2, because you're not going to beat those diminishing returns when you have a loss.
Right.
And because when you lose, you lose more. Right. Because then you have less to trade with, and eventually you might have nothing to trade with. So, you want to be, write this down. Be more accurate. Be more accurate, meaning you want to select the very best trade you can select. You don't want to just the problem with trading is people become a kid in a candy store, meaning that they say, oh, let me get some of this, let me trade this, let me do this, look, it's on TV, this, that, this. Not really being selective, not really willy-nilly,
Right.
And that's detrimental because you need to be behind your trade 100%. So right. I always use the analogy as if your boss flies in from New York. Your boss flies in, and you're a trader, and you're working in a trading firm. And your job is to make money. Right. Remember Mr. Morgan?
Yes, sir.
Mr. Morgan's flying in from New York or from Texas, wherever he's flying in from. And now here's the scenario, okay? You're a trader. Now, your supervisor, who is between you and Mr. Morgan, says, Kerwin, today, Mr. Morgan's flying in he's going to watch you trade. And I want you to know that if you mess up, that's my ass. He tells you.
Right.
And if you mess up, I'm going to fire you. I'm not going to fire you because I don't like you. I do like you. I'm going to fire you because if you mess up, we're both getting fired.
Right.
So Mr. Morgan's flying in and he's going to watch you trade. And I want you, Kerwin, to just trade one time. Just one trade today. Like, look at all the possibilities. Like, select the very best trade that, like, your life depends on it. You have to make money on this trade, okay? Because we have some losses in our department, and I gotta explain that. And I'm gonna prove. I told Mr. Morgan I got this star trader named Kerwin. I'll show you. This guy's gold. He's gonna like. I'm gonna show you his gold. I gotta prove myself. You gotta prove yourself.
Right.
So do no damn willy-nilly trade. Do a trade that you could 100% get behind. Like, your life depends on it. Like, if you lose money in this trade, think about I want you to bite your hand until it bleeds. that's how much I want you to be accurate on this trade.
Oh yeah.
So think about that when you're trading. You don't need to do a lot of trades. You don't need to do it willy-nilly. You need to do just one trade at the time to make money.
Right.
So pick the very best trade. Like, if you've been more country, you got Starbucks, you got the Qs. For this is me talking to myself. I got Netflix. I got Nvidia, Chipotle. So pick the one that you think is a very high chance it's gonna be profitable, and just eliminate everything else. Just do one trade at a time like that. You follow me?
Gotcha.
Because you want to increase your accuracy, right down. Increase accuracy. Can't afford to have losing trades, because losing trades, you're gonna be washed up. You're not gonna hit your goal.
Right.
Questions?
I rode Starbucks after January also. I don't know if I ever told you that.
We talked about that. I have October myself. I have October. I picked up some October 90s, and I already had 85s.
Right.
I have some 80s. Yeah, I think that's gonna come back. I think we're gonna do well on that. I think it's gonna. They sell cold frappuccinos for summer.
Right.
I think summer's gonna be good for summer. There's another company called Bros Brothers. No,
Yes.
Bros Brothers. I said it right.
Dutch Brothers, I think it is, something like that.
Sorry. So yeah,
There
thank
you go.
you. Dutch Brothers. The symbol is Bros, BROS.
Yes.
Now the thing is, they're not better than Starbucks. They're small, but
Right.
they're like up and coming. They're like the new up and coming flavor of the month. So it's like they're actually giving Starbucks some competition.
Yeah, they're
So like,
growing.
like if you were a CEO, what you do, and you're a new company, you look at the old company, what they have, and then you try to beat that. You try to improve on it.
Right.
That's how they're doing. They're like, look, Starbucks has this and that. We're gonna beat this. We're gonna do this better. We're gonna do the customer service better. We're gonna do the quality better. We're gonna maybe have a lower price. They don't have to make money out of the gate. They just need to get some attention, some good publicity, and the stock starts going up.
Yeah.
So keep an eye on Bros, symbol BROS. What?
I said they just need to pull some market share over there and
Yes,
grow from
market
there.
share.
Yeah.
Look. Market share is about position.
Right.
About position. Like, if you were going to do, you said dividend stocks, right?
Right.
What position is a top dividend stock? Write this down. MO's doing great. MO is paying like 8.5% return right now a year, but for a dividend stock, that's great.
Right.
Back in the day, we used to say the Mighty Mo. It used to be called Philip Morris, but they split their company into two. Philip Morris being PM, which is a tobacco for the USA, and then there's MO, which is Altria, which is
Right.
which is the tobacco sales for the world market.
Oh, okay.
And they divided up into two companies for legal reasons, but one of the symbols stayed the same, MO, and they're paying a great dividend. And I would say they're probably number one right now in dividend stocks. The stock is ranging from let's say 30 to 50, and that's a big swing.
Yes.
That'll keep some people out of the market.
Right.
But if you're looking, what they do, what the dividend investors do, is they want to get that fat dividend, so they beef up their shares, get the dividend, and then when let's say it's 40. Can you pull it up right now, Mo?
Yeah.
It's around 40 right now. Give me a price. So what they'll do, they'll get the fat dividend every quarter. It's a pays quarterly, and then actually ML pays, I think, 98 cents a share, and then when it dips, let's say to 35, 33, they'll buy more shares, okay, because they're buying it for cheaper. Then it goes back, and it goes back up to 40, goes back up to 45, 47. Then they can actually trade those shares if they want to trade.
Right.
Goes back down to 40, get the dividend again. Here comes the next quarter dividend payment. Drops a little bit, buy it back up, goes up, but comes down, goes up. So you're getting the dividend, but you can also trade the volatility, trade the peaks and valleys.
Right. And their price is 44.32.
All right, 44.32. Now, can you see from where you are the yield?
Let me look.
I'll just tell you it's around 8.5%.
Okay.
The point is the yield is a percentage, but the dividend is not a percentage. The dividend is a dollar amount. So let's say it pays 98 cents a share, right, per quarter. So it pays like $4 a year, right? But
Right.
Which is 10%. If it's $40 a share, 10% is $4. So you're getting $4 a year, which is not great, but it's great for a dividend stock.
Right.
And why is our dividend stock great? Because you can get $1 million together, and if you get 8% dividend, that's $80K, and you can live on that $80K. That's why.
Right.
You don't got to trade. You don't got to worry about markets fluctuations. You just hold those shares, get that fat dividend.
And that's what I want.
Another one is WHF. I just said W. William Harry Frank. I got this one from one of my clients. WHF. They're paying closer to over 10%, 10% plus.
Wow, really?
But it's a smaller company. I would say more risk overall, but they're pretty steady. Look into that. MO, WHF. I had one that came down a lot, that got hammered. IEP, Icon Enterprises. They're doing great for a long time, for freaking 30 years. They're doing great. And one day the stock went from like 40 to 20. Now it's like 16. So always be ready.
Looking at that stock earlier today.
Yeah, IEP, right now. Always be ready for your stock. Any stock can get hammered. It's just part of the game.
Yes, sir.
There's no guarantees in the market. No.
Let me ask you about this stock.
No
What about Vail? Have you ever looked into them? VALE?
No, but I'll tell you what. Is that the symbol?
Yes.
I'll look into it then on part 2 next week. Are we doing next week?
Okay, that works.
I'll tell you what I think.
Okay.
I think we're about time.
Okay, sounds good.
Did you write down the distribution of income?
I did. Got it all written down.
That's where your money's going. We covered distribution of income. We covered order your free checking to pay bills. We talked about a couple trades, QQQs, SPX, ES. Talked about a couple dividend stocks, MO and WHF. Talked about winning versus losing. When you lose more, so you have to be more accurate. You have to have a high ratio of wins to losses, 7-3 or better. Sound good?
Sounds good to me. I appreciate it.
When you get your 20K a month.
That's the goal.
I want to give you some homework. Do some trades that may get you 20K a month, and then write it down on paper. I want to see what you come up with, because now we're going to put this to action.
Okay.
Sound good?
Sound good to me.
Thank you, sir.
Thank you.
Happy Father's Day.
Same
See
to
next
you.
week. All right.
See you. Yes, sir.